Hi, my name is Brenton Harrison, and we're here today to talk about how to pay down one of the toughest forms of debt that you can tackle financially, credit card debt. Let's get started. Paying down credit card debt is really one of the toughest things that I think a person can do financially. And there's so much working against you when you're trying to tackle a mountain of credit card debt. The interest rates are really high. The payments really don't make that much sense, even for a person that works in finances. And it's definitely tough to resist the urge as the months go on to put a purchase on a credit card that you can't really afford to pay now and you'd rather just put off until a little further in the distance. So it's a hard thing to do. And even though I work in finances every day, if you think that I've never had to face a mountain of credit card debt, you are incorrect. I've been right where you are if you're watching this video. Because of all these factors, when you're staring down credit card debt and trying to figure out the best way to pay it off, it can be really tough to kind of figure out what's what. Is this person credible that I'm reading about? Is this method credible? Is this resource the best one for me? And until you get into the thick of it, paying down your credit card debt, you can't really know for sure. So what I thought we would do today is we would give you 3 different ways you can pay down your credit card debt. And these ways are going to be based on the credit score that you have going into this journey. Because everything that you see online about ways to pay down credit card debt is not necessarily possible depending on the score that you bring to the table at the start of this process. So each of these ways is going to be laid out with not just the method, but the type of credit score that you have to pursue this method. And we're going to go from lowest credit score to highest credit score. And at the end, we'll talk about you finding the right fit for your finances. First, we have debt snowballs or credit card snowballs. And this is probably, I would say, the most well-known form of paying off credit card debt. And it's one that fortunately you can do regardless of what your credit score is. If you have perfect credit already and you're just trying to get some balances off of you, that's fine. If your credit is terrible, but you still have some cards with a balance on them, this will work for you just as well. Debt snowballs work off of the principle of momentum. You first find some money in your budget that's a little extra that you can throw on a payment, and you take that extra money and you apply it to one debt at a time. And you do so in a particular order. And the hope is that after you pay off one debt, that momentum will keep building and building and building, and you can use it to pay off all of those debts by the end of the process. Here's how the process works. Remember, first, you have to find an additional amount of money in your budget that you can apply to your debt snowball. And once you find that amount, you take it and you apply it to the minimum payment for the first debt in your debt snowball. And you make that extra payment plus the principal payment until it's paid off. Now, after it's paid off, you take the extra amount plus the minimum payment from the first debt, which is now gone, and you apply both amounts to the next debt in your snowball. Once that second debt is paid off, you apply the extra amount plus the first debt payment, plus the second debt payment, and all of that money now goes to the third debt payment. And the payments you're making become bigger and bigger and bigger, but you're never increasing the amount above and beyond what you paid in the first month. So you're using momentum to pay off all the debts, but you're never exceeding the amount that you set aside for your monthly commitment to your debt snowball. Now, there are 2 forms of debt snowballs that you can pursue. One of them pays off your debts in order from lowest balance to highest balance, and the next form of snowball pays them off in order from highest interest rate to lowest interest rate. First, let's cover snowballs that pay off debts from lowest balance to highest balance. The theory behind these snowballs is that we as human beings work best when we get to see tangible progress. Because a debt snowball is really hard. If you have a lot of credit card debt, just because you've heard of a snowball, it doesn't automatically make it easy to pay off credit card debt. And if you have that first card that you're tackling and it's a really, really big debt and it takes you months and months or years to pay it off, the theory goes that you might lose the motivation to continue the snowball at some point along that journey. So by organizing them from lowest balance to highest balance, the hope is that the first one that you tackle is a really small amount and you can pay it off quickly and have and see and feel the tangible progress of the goals that you're pursuing. And it will give you the motivation to keep pursuing them until the end of the process. There is a potential con for pursuing your debts in this particular order. And that con is that the lowest balance that you have may not be the highest interest rate credit credit card in your lineup of cards. So if you're paying that card off first, yes, you get the tangible motivation, but you could be leaving higher interest cards to the back of your Snowball. And by doing so, you're actually increasing the amount of time that you're going to spend paying off your debts and potentially increasing the amount of money it will cost to pay them off in the first place. One of the ways that you can combat this, if you feel you have the motivation to keep going no matter what, is to pay those debts off in order from highest interest rate to lowest interest rate. Highest interest rate to lowest interest rate snowballs work best in terms of limiting the amount of money that it takes to pay off your debts because they're eating through the high interest cards with those extra payments quicker. If you leave those high interest cards to the end of your Snowball, you're going to keep making those minimum payments and that debt is going to stand still at that high interest rate at best, or the balance that you owe could even increase. But by adding that extra payment first in the Snowball, you're eating through the interest quickly, and then further you get into that Snowball, hopefully you're going to be paying down debts that are actually even easier. So with lowest to highest balance, the easy part is at the beginning. You're paying off the lowest debt at the front end of the Snowball to give you that motivation. With highest interest to lowest interest, you're tackling the big boys first. And if you can get through those, it actually makes the Snowball easier as you progress through the cycle. Not in terms of the amount of money you're paying, but in terms of how much of that money is going to the principal of what you owe each and every month. Let's look at an example of 3 credit card balances and how an extra $200 a month could be put to use in a debt snowball strategy. We have one card with a $2,000 balance. The minimum payment is $100 and the interest rate on that card is 20%. The next card is $5,000 in terms of the balance. It has a $100 minimum payment and the interest rate is 25%. So this is the highest interest rate, while the first credit card has our lowest balance of these 3 cards. And the last card is right in the middle. It's $3,000 in terms of the balance, $100 minimum payment, and an interest rate of 18%. Now, with these credit card balances and interest rates, using the lowest balance strategy would mean paying an extra $200 towards the $2,000 balance first, as it's the lowest amongst these 3 cards. Now, even though you're paying that first, its interest rate is not the highest. We're leaving that card off until later in our Snowball. We could pursue this option, but remember, we're leaving that $5,000 card, which is not only the highest balance, but also the highest interest rate, sitting and accumulating at 25% interest, and it's at the back end of our Snowball. It's the last one we're going to tackle. So by doing this, it's going to cost us the most money over time. Conversely, we could pursue a highest interest Snowball, and that $5,000 card will be the first one we tackle because it has the highest interest rate of the 3 cards that we're looking at in our debt Snowball. The next method we're going to talk about in terms of how you can pay off credit card debt does take decent credit. This is not something you can do if your credit score has just been completely wrecked as a result of your past behavior. But this option is using the proceeds of a personal loan to pay down your credit card debt. Personal loans are loans that are offered by lenders based on the strength of your personal application, namely things like your credit and your income and the dependability of your income. Now, these loans are a form of unsecured debt, and that simply means that there's no asset, physical asset like a home or a car, that the bank or a lender can seize if you don't pay them back. A bank or a loan that has a car loan or a mortgage is taking that property, the car or the home, and they're using it as collateral. And if you choose not to pay back that car loan or that mortgage, they can come and they can get that car or they can come get that home. So because of that, the bank has a way to cover their risk that you don't pay. And when they have a way to cover that risk, they typically don't charge as high an interest as they could. Now, if you're wondering how that factors into a personal loan, since a personal loan is not secured, it's actually similar to a credit card. A credit card is also unsecured debt. If you choose not to pay off your credit card, the bank or your credit card company, they can't come get your car. They can't come get your home. And that's one reason why interest rates on credit cards are so much higher than you would find with a car loan or a home loan. Well, the same is true for personal loans. The interest rates on personal loans as unsecured debt are higher than what you would find with a mortgage or a car loan, but they are lower than what you find with credit cards. They kind of sit right in the middle. You have credit cards on this end of the extreme, you have home loans and car loans on this end of the extreme, and right in the middle, you'll find the interest rates for that of a personal loan. Now we're talking about taking out debt to pay off debt, so you're probably wondering what's the purpose of that. Well, first, credit card debts as compared to personal loans, there are still interest rate savings. So I would rather pay off debt at 10% as compared to paying it off at 20%. So by having those rates that kind of sit right above a mortgage but right below a credit card debt, a personal loan does offer you the opportunity to have some interest rate savings. But they also give you a definitive payoff date for the future. And that's one thing that makes credit card debt so tough to pay off. You don't have to pay it off, and if you choose not to, you can owe that debt for the rest of your life. You can die with credit card debt. Whereas with a personal loan, they're going to give you a certain length of time in which you have to repay them, and at the end of that period, that debt will be paid off in full. So you'll know definitively when that monkey will be off of your back and you can move on to other things. Not only that, when you use personal loans to pay off credit card debts, you can see your credit score improve before you've even made the first payment on your personal loan. And if you're wondering why, it has to do with the difference between installment debt and revolving debt. If you followed this channel for a while, you know we've gone through the elements of a FICO score in pretty good detail, and we've given a lot of particular attention to an element of your score called credit utilization. Credit utilization ratios are an expression of how much of your available credit you've borrowed at a particular point in time. If you have $10,000 of available credit, and at the time your score is checked, you've borrowed $5,000, your utilization ratio is 50%. You have borrowed half of what's available to you. Credit utilization is a huge part of your credit score. It's actually the second biggest component of your credit score, and it represents 30% of what they use to calculate the number that you see when your score is pulled. And you probably have also heard the 30% rule. 30% rule applies to credit utilization, and it says that if you keep your credit utilization ratio below 30%, you should not see this element of your score have a negative impact on that overall number. So if you have that $10,000 available, the theory to the 30% rule says as long as you keep your balances below $3,000, 30% of that available credit, your score should be fine for this area. While there's an element of truth to this, studies have actually shown that people with perfect credit keep their average utilization ratio below 10%. So in reality, the lower the better in terms of your utilization ratio is a better rule of thumb than the 30% rule. The lower you can keep it, the better it will be for your score. So how does this factor in with personal loans? Well, the good thing is, as compared to credit card debts, which are a huge part of your utilization ratio, personal loans are not used to calculate your utilization ratio at all. Here's where that difference comes in between installment debt and revolving debt. Credit card debt is revolving debt. Revolving debt is a form of debt that has an endless amount of times you can borrow the amount of money made available to you. If you have $10,000 on a credit card, as long as you pay off that card, you can borrow up to $10,000 over and over and over again. There's no definitive time that you have to pay it off. There's no definitive time that the card itself will expire. You have a countless number of times you can borrow that available credit limit. This is revolving debt. Personal loans are a form of installment debt, and installment debt is way different. With installment debt, there's a certain amount of time in which you have to pay off that debt, and it's only made available to you once. If you take out a personal loan for $10,000, you can't pay half of it off and then go borrow up to that $10,000 limit again. No, you get a $10,000 personal loan. They're going to tell you, here's how long you have to pay us back. Here's the interest rate, and here's the amount of money it will take for us to be paid in full at the end of this period. They're giving it to you in one installment, and you have to have that installment paid back within a certain amount of time. Mortgages, student loans, even car loans are all forms of installment debt as well. And none of these forms of loans are factored in when calculating your utilization ratio. So when you take your personal loan, which is installment debt, and you use it to pay off credit cards, which are revolving debt, you are essentially removing all of that money from the calculation of your utilization ratio. And even though you haven't paid off the personal loan yet, you immediately improve the utilization ratio by removing these funds from the calculation. Let's look at an example. We have a credit card with a $10,000 limit and $6,000 owed on the card. Now, these totals mean that their utilization ratio for this cardholder is 60%, and that's far too high to benefit their credit score. So let's assume that they find a lender who will be willing to offer them a personal loan for $5,000 at a lower interest rate than what they're paying towards the credit card. Now, we're going to use that $5,000 to pay down our card balance, which is going to lead to the following results. They take out the $5,000 personal loan, they pay off $5,000 of credit card debt, and their personal loan balance is $5,000. But that balance from the credit card, which we did owe $6,000 on, will now reduce to $1,000. Now, in total, they still owe $6,000. We have not reduced their total amount of debt. But what we have done is greatly lowered the amount they owe on that one card. So if they have a $10,000 limit on that card and their balance is now reduced to $1,000, we've taken their utilization ratio from 60% to 10%. And 10% is something that can improve your credit, and it can improve it quickly given the state of other factors on your score. So the balance of that personal loan isn't reflected in the utilization ratio, and the lower interest rate on that personal loan will also help us pay down our total debt at a lower cost. The last option for tackling credit card debt is credit card surfing. And this is a form of debt payoff that unfortunately requires excellent credit to pursue. And I would say it requires a great level of discipline that you may not have. So even if your credit is great, you want to proceed with a level of caution before pursuing credit card surfing. But here's how the concept works. Credit card surfing is the concept of transferring balances from one card to another card to take advantage of a difference in interest rates. As long as the person who's applying has strong or excellent credit, credit card companies are going to offer some pretty amazing introductory rates and introductory offers to try to entice a person to switch from one card to another or to just get their card in the first place. If I'm an American Express customer and I've been with them for a decade, CitiCard has to work pretty hard to get me to switch from American Express to their new card. And to do that, they're going to offer me an introductory offer. They might say things like, hey, all purchases that you make over the next 12 months, you can make at 0% interest if you make them on your credit card. Or they can say, hey, if you use our credit card, we're going to give you $100,000 in bonus rewards points as long as you spend X amount of dollars in the first 3 months. There's all types of stuff that credit cards will throw in those introductory offers. But another standard part of those offers for people with excellent credit is an introductory period where any balances that they transfer from one card to another will have 0% interest charged for that initial period. So in my example, if I have a ton of money that I owe on that American Express card and CitiCard gives me a year where I can move money from American Express to their card and pay it down at 0% interest, over the course of the next 12 months, I'm going to try to balance transfer as much as I can from American Express to Citi, and I'm going to pay down that debt quickly so that I can have that 12-month period to attack it at 0% interest. Now, it's important to note that there is typically a one-time balance transfer fee. So even though I may be able to have it at 0% once it gets to CitiCard, they might charge me 3% or 5% for that initial transfer. And we're going to show you an example in a minute. But let's say that at the end of that 12-month period, unfortunately, I still owe credit card debt. I took advantage of it for a good while, but now I still have something that I owe, and I'm going to watch that interest rate offer expire, and now it's going to start being charged those higher rates again. Well, instead of paying down that credit card debt at high interest, I might find yet another card that I can apply for that has an introductory rate, and I'll take it from CitiCard and maybe move it to Capital One. That's why they call it surfing. You're literally going from one card to the next card to the next card, taking advantage of those introductory rates so you can pay down your debt at the lowest interest rate possible. Let's look at an example in action. A borrower owes $6,000 on a credit card with a $10,000 limit. Now, in addition to the damage this is likely done to their credit utilization, which sits at 60%, the interest rate on this card is probably pretty high if it's your standard credit card. So what they do is they scan the marketplace and they find an introductory offer with a balance transfer credit card. And that credit card gives them 12 months of 0% interest. And during that period of time, they're going to charge an initial 3% transfer fee. So we're going to see what happens when they take $3,000 from their current card and they transfer it to the new balance card. Transferring the balance from the old card to this balance transfer card is going to generate a $90 transfer fee. Remember, they charge 3% to bring the money over, and 3% of $3,000 is $90. Now, this fee can be paid in cash, or you can have it added to the transferred balance, which is what we're going to do in this example. But once the funds are transferred, the new balance sits at 0% interest for the entire 12 months, and the cardholder can use this year to pay down the debt at a lower cost. Now, as you can see in our example, opening that new card, it increases the total credit available to the borrower, and it decreases the utilization ratio on their old card pretty significantly. So rather than owing 60% of their $10,000 credit limit, they now owe around 30% of their $20,000 in available credit, which could radically improve their credit score as well. So this benefit shows the pros of credit card surfing in action. We hadn't even talked about the improvements to your utilization ratio, but when you apply for a new credit card, you are going to increase the amount of available credit at your disposal. So even though you haven't paid down any debt, you are lowering the percentage of your available credit that you owe, so it provides an immediate improvement to that utilization. So what are the cons? Well, we've already covered that it takes excellent credit to qualify for these introductory rates. But not only that, opening a new credit account causes damage to two other elements of your credit score: the age of your accounts and the credit inquiries. Now, these two elements combine to represent 25% of your FICO score. So while the credit utilization ratio, it is a larger part of your score at 30%, you can't pinpoint the exact impact opening a new card will have until after you've opened it. That's it. 3 different ways to lower your credit card debt based on people who have terrible credit, people who have decent credit, and people who have excellent credit. Now, I never said it would be easy, but you can get out of credit card debt. If you do a little maneuvering, if you have a strategy in place that works for you, it can be done. And hopefully one of these methods speaks to you in a way that you can implement in your finances. My name is Brenton Harrison. I appreciate you guys joining us for this video. If you haven't already, subscribe to our channel and subscribe to notifications so you know when new content is being posted, and we'll keep bringing it to you as frequently as we can. Have a good one.